Hey folks, welcome to our discussion of Chapter 26, the savings and investment in the financial system. Here's why this chapter is important. First and foremost, just savings, investment in the financial system is a huge part of what you think about or what you talk about when you think about a macroeconomic system. So this chapter will help you understand a lot of what you see just in the world, in the financial news, in the Wall Street Journal. The chapter helps you understand a lot, but that's secondary. Here's the key point. In the previous chapter, we talked about how one of the key determinants of productivity is physical capital. Capital accumulation is a big part of what makes an economy productive over the long run. And without a healthy level of capital accumulation, that's productivity growth, prosperity in the economy overall is going to be greatly impeded. That's a big deal. Well, it's this financial system, it's this chapter, this is what allows for a healthy level of capital accumulation. So to understand that important part of productivity growth over the long term, we have to understand the financial system, we have to understand how it works and what can cause it to get messed up and what can cause it to be more healthy. So that's the point of this chapter. Financial system allows for healthy capital accumulation if it works properly, and that's a key determinant of long-run productivity growth and prosperity. So let's get right to it. Should be a really interesting chapter. I'll go to screen share, go to my PowerPoint. As you see, the function of the financial system is to channel funds from savers to investors in a healthy way. Now, savers, we're using somewhat different terminology here than what you might hear kind of in the common world or in the common news or whatever. Savers are people who are putting money into the financial system. Savers are people who have kind of more income than they have in expenses, and they're taking their extra income and they're saving it for a rainy day, or to save for a down payment on a house, or to save for an engagement ring, or whatever it is. Savers are people who are putting money into the financial system. Savers operate by buying bonds. Savers operate by putting money into the bank. Savers operate by buying stock or buying mutual fund shares. That's savings behavior. Savings can be referred to as financial investment, right? If you buy a bond, or if you buy a stock, or if you buy mutual fund shares or those things, some people just call that investment. But here we're being more precise and we're calling that financial investment. It's savings. That's what we call savings in this chapter, in this course. Now, investors, on the other hand, are the people who are taking money out of the financial system. Investors sell bonds. They borrow money from a bank. They sell stock. They're engaging in those activities to acquire financial capital so they can purchase new physical capital. They are investing in physical capital. So we have savings, putting money into the system, buying bonds, buying stock, putting money into the bank. They're engaging in financial investment, but then investors are engaging in physical capital investment. They're taking money out of the system by selling bonds, by borrowing from the bank, by selling stock to acquire money to buy new physical capital to grow and expand and to make the economy more productive. Investors are entrepreneurs or businesses. That's what we mean when we're talking about savings behavior and investment behavior. And be sure that you're clear on that, because this whole chapter will be weird if you're not clear on that terminology. Here's just a little kind of simple diagram. On the one side, we have savers. They're putting money into the system. And savers are effectively lenders. Savers are lending money. The activities that they engage in are either directly lending money or lending money in some indirect way. Then over here we have investors, businesses, entrepreneurs who are borrowing money, who are acquiring financial capital, acquiring money from the financial system. Now we have a direct linkage. This is supposed to be a green line with an arrow on it. I don't know how it got turned into red, but whatever. There's a direct linkage between savers and investors, and that's called direct finance. Not too surprising term there. The direct linkage is called direct finance, but that's also referred to as financial markets. Or on the other hand, there's an indirect linkage where we have financial intermediaries who stand in the middle between savers and investors and help coordinate that activity. Financial markets, or otherwise known as direct finance, or on the other hand, we have indirect finance, otherwise known as financial intermediation, where there's someone standing in the middle to coordinate that activity. The point remains, in either context, savers are putting money into the system, investors are taking money out of the system to invest in new physical capital. It's just a question of whether we have this direct linkage or whether we have an intermediary in the middle. Now, financial markets, that's where we'll start. We'll start by talking about financial markets. The first financial market we'll talk about is the bond market. If you acquire financial capital, if you raise financial capital by selling bonds, then you're engaging in debt finance. A business can sell bonds to borrow money, to acquire financial capital. If they do that, they're expanding their business through debt finance. A bond is just simply a certificate of indebtedness. It's a promise to pay money at some point in the future. That's all a bond is. If I sell you a bond, you give me money in exchange for that bond. What I'm really selling you is a promise that I'm going to pay you a certain amount of money at a certain time in the future. Bonds can vary widely. There's all different kinds of bonds floating around in the world. They can vary widely. When a bond contract expires, whenever the whole contract that we arrange comes to an end, that's called maturity. And maturity can range widely. Bonds can mature in a month or less even, or bonds can be stretched out all the way to 30 years. So you have a huge wide range in terms of kind of a time picture for bonds in terms of time to maturity. And bonds also vary in terms of type. Now, I'm not going to go through the different types of bonds. I think that's explained pretty clearly in the book. And for the sake of brevity in this video, I'm just going to tell you, just read the description in the book on what a coupon bond is, on what a discount bond is, and what a fixed payment bond is. Those are all very common types of bonds. Just read about those, and it's very straightforward, but you should familiarize yourself with that. I mean, any person in general or any person in the business world should know the difference between a coupon bond, a discount bond, and a fixed payment bond. Now, bonds, the first type of risk with a bond is, of course, called default risk, right? There's a risk that the person just won't pay you back, right? If I've bought a bond from an entrepreneur or from a company, there's some risk that person is just simply not going to pay me back. They're going to go bankrupt. They're going to disappear. They're not going to pay me back. So bonds vary widely in terms of risk. Just imagine this. Suppose we have a really big, well-established, secure company selling bonds. And suppose we have a brand new entrepreneur who's just starting out, who's selling bonds. Suppose both of those people are trying to sell bonds at the same interest rate. They're both willing to pay the same rate of interest for that bond that they're selling. A big company like General Motors that's been around a long time, that's pretty stable, is pretty certain to pay me back, versus a new entrepreneur who may go bankrupt in 6 months and who may never even dream of paying me back. I mean, in that case, who are you going to buy a bond from? If you're a person who's thinking about buying a bond, who are you going to buy a bond from if we have a high-risk person and a low-risk person, and they're both offering the same interest rate? Obviously, nobody in the world would buy that high-risk bond if it's paying the same interest rate. So for high-risk borrowers to be able to get anybody to do business with them, they're going to have to offer higher interest rates to compensate people for that extra risk. So what we find is that lower risk bonds that are very safe and secure, and we're not worried too much about default, lower risk bonds pay lower interest rates. higher risk bonds pay higher interest rates. There's this inverse relationship, or there's this relationship between, not an inverse relationship, but a positive relationship. As risk goes up, the interest rate paid on the bond goes up. Now, suppose you're thinking about buying a bond. Suppose you have 10 different companies you're thinking about buying a bond from. How are you going to know? I mean, how are you going to know how risky those companies are? I mean, have you gone out and done your own personal research to understand the level of risk in all these companies? Probably not. The thing is, we have 3 big companies in the country that really specialize in looking at companies, looking at how risky they are, and just assessing, okay, this is a low risk investment, this is a high risk investment. One of those companies is called Standard & Poor's, S&P. The other 2 are Moody's and Fitch, and they each offer bond rating services. Just on the screen, I've given you the rating scale that S&P uses. The other 2 are very similar scales. There's not that much difference there. But S&P, if you're a AAA bond, that means you're very low risk. The lowest possible risk you can imagine, that's a AAA bond. And then it goes down from there, AA plus, AA minus, A plus, all the way down. Above a certain threshold, right, bonds that have a rating above a certain threshold, bonds that have a risk level that's below that certain threshold, those are called investment grade bonds. And then bonds that fall below that threshold, bonds that are from companies that are very high risk, those are called junk bonds. Anyway, those companies provide a really valuable service by helping people understand how risky different bonds are. This applies to corporate bonds, and governments also issue bonds. The state of West Virginia issues bonds. The nation issues bonds. Different cities issue bonds. So it's not just private sector; it's also public sector bonds. The way it works is, if you are going to issue a bond, in order to get anybody to buy that bond, you're going to have it rated. So if you're issuing a bond, you'd actually go to the bond rating company and say, hey, I want you to study my situation, and I want you to give us a rating on how risky these bonds are. And you pay a fee to the company for doing that. That's how it works. The person issuing the bond, the business or the entity issuing the bond, pays a fee to the bond rating company to have the bond rated. So default risk, I think, is very straightforward. I think everybody can understand default risk. That's not the complicated part of it. But there's another type of risk. It's called interest rate risk. And I want to talk about that for a minute, because interest rate risk is also an important part of risk, but it's not quite as obvious as default risk. So suppose we have a coupon bond. Now, if you haven't read about what a coupon bond is, pause the video and go read about the structure of a coupon bond. So for the coupon bond, it has a face value. I'm going to pick out the simplest numbers I can possibly think of to make this point. But suppose the coupon bond has a face value of $1,000, has a coupon rate of 10%, the time to maturity is 2 years, and the interest is paid annually. Right? These are the most simple parameters you can possibly imagine, and it's straightforward. So assume you purchased the bond on January 1st, 2008. And just assume you purchased the bond at face value. Purchase it for $1,000. You can purchase a bond for face value. You don't have to purchase a bond for face value. It can be a different price. But for right now, we're assuming the bond is purchased at face value. So we purchased it on January 1st, 2008. And so since it's a coupon bond, the bond will make an interest payment on January 1st, 2009. 1 year later, that interest payment will be calculated as the coupon rate times the face value. So in this case, it'll be 10% times 1,000. It'll be a $100 interest payment after 1 year. And then after 2 years, there will be a second coupon payment. Another $100 will be paid. But then since this is just 2 years to maturity, then for this bond, it's going to mature as well at this point 2 years later. And so at maturity, the face value will also be paid back. So the bond is purchased January 1st, 2008. There's a coupon payment, January 1st, 09, equal to the face value times the coupon rate. Then January 1st, a year later, 2010, there's the second coupon payment of another $100, and then the face value is paid back since that is maturity. That should be straightforward, okay? That should be straightforward. That just follows from the very structure, the very definition of what a coupon bond is. Now suppose we go to January 1st, 2009, right in the middle of the scenario, 1 year after the bond has been issued, but 1 year before it matures. You can just hold the bond until it matures, obviously, and that'll be straightforward, right? You can hold the bond until it matures, and the story that we just told will play out, and there won't be anything else interesting to discuss. But you don't have to hold the bond until it matures. You can sell the bond if you want to. If something happens and if you just need your cash quick, you can sell that bond. When bonds are initially issued, by companies to raise financial capital, for physical capital investment, that's called the primary market, right? When new bonds are issued to finance capital investment, that's called the primary market. But if you were to take that bond that you own, that's already been, that was issued a year ago and that has a year left until maturity, if you were to take that bond and sell it, then that would be activity on the secondary market. So the primary market and the secondary market. In this course, in this chapter, when we're talking about the financial system and its role in fostering physical capital investment, we're mostly thinking about the primary market there. But the truth is the secondary market has way more activity than the primary market. Out of all the bond transactions that occur in a year in this country or in any country, most of that activity is secondary market activity. Anyway, on January 1st, 2009, you could sell the bond if you want to. And so this equality must hold, right? This is a key equality. This must hold. The value of the bond times 1 plus the interest rate equals the future payment that in this example comes in 1 year, right? The value of the bond times 1 plus the interest rate equals the future payment in 1 year. Or $1,000 times 1.1, we specified a 10% interest rate to begin with, it equals $1,100. Okay, the $1,100 is the future payment, right? That's what the bond is going to pay in 1 year on January 1st, 2010. And then here we have 1 plus the interest rate. We're assuming 10% is still the rate in the market. You could sell that bond today for $1,000. Does that make sense? On January 1st, 09, 1 year into this transaction, if you decide that you want to sell the bond, you could sell it on the secondary bond market for $1,000. It would follow from this equation. The value of the bond, $1,000 times 1 plus the interest rate equals $1,100. Okay? And this is a simple formula, right? I mean, if you were just to take money and put it in the bank, right? If you were just to take $1,000 and put it in the savings account at a 10% interest rate, in a year, you'd have $1,100 in your account, right? So this present value times 1 plus the interest rate equals the future value. It's the same idea. Here's the future payment, which is stipulated in the bond contract. Here's 1 plus the interest rate. That gives you the value of the bond today. Right? That equation can be worked with forwards or backwards. The equation is straightforward, should be straightforward. But that equation, it's assuming that 10% is still the interest rate that's prevalent in the market. But what if market interest rates rose to 20%? What if market interest rates rose to 20%? Could you sell your bond for $1,000 now? Suppose I'm thinking about buying your bond. If I buy your bond for $1,000, I'm going to be getting a 10% rate of interest on that bond. But we just said market interest rates rose to 20%. So I could go down the street and get 20%. I'm not going to buy your bond for $1,000 and get 10% interest if I can get 20% somewhere else. That's stupid. So this is what we're going to have to do. If you want to sell your bond on the market now, after market rates have risen to 20%, we're going to have to use this formula, right? We still have this $1,100 here, right? The $1,100 is fixed in the contract of the bond. You can't do anything with the $1,100. The bond is going to pay $1,100 in 1 year, and that's it. There's nothing you can do with that, okay? But now we know that market interest rates have risen to 2%, so this 1 plus the interest rate figure comes to 1.2 now instead of 1.1. So then we calculate for the value of the bond. If you do that little math, the value comes out to $917. If you sell this bond for $917, then the person buying the bond will earn a 20% rate of interest over the course of the year. So if market rates have risen, the only way that you can sell your bond is to sell your bond at a price that corresponds to that prevalent rate in the market. You're going to have to drop your price to $917 to make that happen. If you go and if you sell your bond after 1 year, after rates have risen on you from 10% to 20%, you're going to suffer a capital loss of $83. You're going to suffer a capital loss of $83. This is another type of risk that exists with bonds. Right? We're not talking about default risk. Right? We're not talking about any company that has, gone bankrupt and isn't able to pay you back. That's not the issue here. It's another kind of risk. If rates rise in the market, and if you sell your bond before it matures, you're going to suffer a capital loss. You're going to, get less money as a result of that increase in interest rates. You're going to have a capital loss. The reverse is, of course, true. If rates in the market had fallen, you would end up earning a capital gain, and that would be great. That would be super cool. Does that make sense? I hope that makes sense. It's another kind of risk that comes along with interest rate fluctuations. Now this kind of risk doesn't apply if you hold the bond till maturity. Right? If you hold the bond till maturity, it's all very simple. It all corresponds to your initial setup. But this kind of risk applies if you sell your bond in the secondary market with interest rates moving around in the market. Now, the second part of the financial markets that we're going to talk about is the stock market. Stock is just, look at this. Here's a typo. A stock is a share of ownership in a firm, right? That's all that stocks are. It's a share of ownership in the firm. If there's a company out there, and just to use simple numbers, if the company has 100 shares of stock outstanding, and if you own one of those 100 shares, then that means you own 1% of everything the company is. It's as simple as that. A stock is a share of ownership in a firm. So if a company wants to raise financial capital in order to finance growth and expansion, it can do that by selling bonds, by taking on debt. It can engage in debt finance, or alternatively, it can raise financial capital by selling ownership in itself. Right? The company can sell stock to raise financial capital, and in essence, the company is selling ownership in itself when it's selling stock. Now, the benefit of owning stock is, of course, the dividend that the stock pays. If a company makes profits, or hopefully when a company makes profits, it has two options. What to do with those profits. There are two options. The company can pay the profits out as dividends, right? That's money paid to the shareholders corresponding to the profits, or the company can just hold on to those profits to finance additional or future expansion, hold profits as retained earnings. Anyway, when the company makes profits, when it decides to pay those profits out to its shareholders, those payments are called dividend payments. That's the fundamental reason for owning a stock. Alternatively, if you have a company that's growing, that's doing better and better and better all the time, if you buy the stock, the stock's going to go up in value over time. you buy the stock at $100, you sell it for $150, years later or whatever, then you've made money on that appreciation of the stock price. And that's, of course, called capital gains. And that's another reason for owning stock. You own stock to receive dividend payments and to earn capital gains when you go to sell the stock. Now, obviously, if you own stock, kind of individual stocks, or even if you own mutual fund shares or whatever, if you own stocks, you care about the price of those individual stocks. But we also care about kind of how the overall stock market's doing. Now, we don't just care about the individual stocks that we own. We also care about what's going on in the market overall. What are all the companies doing? What are all the stock prices doing? So we have these different stock market indexes that have been constructed, that have been calculated to allow us to get a sense of what's happening broadly in the market. The most kind of well-known one is the Dow Jones Industrial Average. The Dow Jones Industrial Average is the oldest one. It, of course, the Wall Street Journal for a long time was owned by, the Dow Jones Company. And so, of course, the Dow Jones Industrial Average is also a product of that company, tied with the old owner of the Wall Street Journal. The Dow Jones Industrial Average is the oldest stock index. Surprisingly, the Dow is only made up of 30 stocks. And the stocks that make up the Dow aren't representative companies. They're just the biggest, most powerful, most influential, most successful companies in our country. They're called blue chips, companies that are big, powerful, successful, stable. The Dow is made up of 30 blue chip stocks. Now, the companies that are selected for the Dow, not only are they, that criteria that I just laid out, but the companies are all also selected to represent the industrial composition of the country. So if 15% of the business activity in the country is in healthcare, then around 15% of the stocks in the Dow are healthcare. If 12% of the country is in manufacturing, then around 12% of the stocks in the Dow are manufacturing. Does that make sense? The Dow is reflected, the Dow is selected to reflect the industrial composition of the country. Even though the Dow seems like incredibly narrow with only 30 stocks, we have hundreds of companies, we have hundreds of stocks in the country, and it seems like the Dow is very, very narrow, but the Dow still gives you a pretty good idea of what's happening in the market because those companies are kind of leading companies. They are such big, influential companies, and they do reflect the industrial composition of the country. So the Dow is still a pretty good piece of information, even though it is, I think, surprisingly narrow with only 30 companies. The better index, the index that I look at personally, and the index that I think most people would look at more often is called the S&P 500. Obviously, it's constructed by that same company that we just mentioned a minute ago, Standard & Poor's. But the S&P 500 is made up of 500 stocks. It's a much broader index, and that's the index that I personally look at. Like when I'm just worrying about, oh my goodness, what's happening to my own stock portfolio, I am thinking about the S&P 500. And you can read about the other indexes. I'm not going to go through all of those for the sake of brevity, but there are other indexes described in the book. And of course, if you go to the financial page of the Wall Street Journal, you'll see more indexes. So here we have this idea of the efficient market hypothesis. The efficient market hypothesis. How much would you be willing to pay for a stock? How much would you be willing to pay for a stock? Well, what you'd be willing to pay for a stock is based on, well, if you're going to sell it next year, if you're going to buy a stock now and sell it next year, then what you'd be willing to pay is going to be a function of the dividends that the stock's going to pay over the next year and what the stock would be worth a year from now. Though, the future value and the dividend payments between now and that future date, that's going to drive what you're willing to pay for a stock. Now, a year from now, the stock would be worth, the dividends that's going to pay over the following year, plus what it's going to be worth 2 years down the road. If you extend this chain of logic kind of onto infinity, then this is what you get. You think about all the future profits the company is going to make and all the future dividend payments that the company is going to pay out correspondingly. So you're going to have a stream of payments that go from now all the way to infinity based on that company, how profitable it's going to be for the rest of time, and those dividends that it's going to pay out over the rest of time. And then you can take that stream of payments and you can do what we refer to as, you can discount those to the present value. Now, you all know, $100 paid a year from now isn't worth $100 today, right? If I were to come to you and if I were to say, hey, do you want $100 now or $100 for a year from now? I'm pretty sure you'd say I want $100 now, right? At the very least, you could take $100 now, put it in the bank, earn a little bit of interest on it, and a year from now, maybe you'll have $101 or $102. So $100 today is worth more than $100 in the future, so we have to use some method to take those future payments and figure out what they're worth today. Now, we're not going to talk about that. We're not going to go into that process. It's not a hard thing to do, but we're not going to do that. But just know that for future payments, we discount those future payments to what they would be worth today. So anyway, you take, to figure out what a rational person will be willing to pay for a stock, what you do is you imagine all the profits the company is going to make in the future. You discount those profits. I'm sorry, let me restate that. You think about all the profits the company is going to make in the future. Correspondingly, you think about all the dividends the company is going to pay in the future. And then you take all those dividend payments and figure out what that stream of payments would be worth today. That's what a rational person would be willing to pay for a stock. And what I just said is kind of a universal principle. That's not anything unique or anything weird. But there's also a risk factor involved. How certain are we on this projected dividend stream that we've laid out? How certain are we? Well, if you're not certain at all, you're going to demand more money to compensate you for that uncertainty. Anyway, I'm just trying to figure out the best way to explain this. Long story short, we believe that the people in the stock market who have the best guess of the future payments, we think those people who have the best guess are ultimately going to be the ones who are setting stock prices. We think the people in the markets who are best at predicting those future payments will ultimately be the ones that are willing to pay the most for stocks, and they'll be the ones that are setting stock prices. Here's what the efficient market hypothesis says. It says that the prices that you see in the market will encapsulate our best guess on the discounted present value of all future dividends. Does that make sense at all? If not, I might have to discuss that in the Zoom call as well. But the efficient market hypothesis says that in the long run, over time, there are always anomalies in the short run. We're not talking about short run anomalies. But in the long run, there's going to be a tendency for stock prices to reflect society's best guess on what is the present discounted value of all those expected future dividends. The efficient market hypothesis says basically that stock prices are good indicators of how profitable firms are going to be in the future. Okay? The efficient market hypothesis says that stock prices are good indicators of how profitable firms are going to be in the future. The efficient market hypothesis isn't always true. There are plenty of anomalies of the stock market doing weird things, of the stock market doing things that don't make any sense. There are plenty of examples of the stock market just kind of going crazy frankly. But in the long run, we think there's going to be a tendency for stock prices to reflect our best guess on how profitable those firms are going to be in the future. If a stock price happens to be unusually low, right? If we decide that this stock price is really cheap, the company's going to be more profitable than what this stock price indicates, then some entrepreneur, some smart person is going to see that. They're going to go out and buy up that stock. And as they buy up that stock, it will drive up the demand for the stock. That'll drive up the price of the stock. They'll continue to do that until the price is driven up to kind of its accurate level, where it should be based on their best guess of future profitability. Does that make sense? I hope it does. Anyway, this efficient market hypothesis idea is really important. If you combine that with this notion of stock indexes, what you get is, lo and behold, the stock market is a good leading indicator of where we're going in our economy. It's a good leading indicator of where we're going in our economy. Now most of the data that we looked at before in the CPI chapter, in the GDP chapter, in the unemployment chapter, those are lagging indicators. Those pieces of data are important. I think it's very important that we study and follow and track those data, but they're lagging indicators. They're looking in the past. They're looking at, oh, this is how the economy did last quarter, or this is how the economy did last month. But the stock market's a good indicator at giving you a guess of where the market's going in the future. It's not a perfect indicator, not by any means, but it's a good indicator. There's a little link for you. I don't know. I recommend you follow that link and just look at how the Dow Jones Industrial Average has moved over time. And you can see major events reflected in the Dow. And you can see how major world events that are likely to affect the profitability of different firms kind of manifest themselves. You can see how they show up in what the Dow does over time. Okay? I'm trying to think, how long are we into this video? I'm trying to decide when to split the video up. This doesn't tell me how long we're into this video. I'm going to keep going just for a minute. I'm sorry to be so scatterbrained here. I'm going to make this a 2-part video, and I don't know exactly where to break it up. Anyway, that's our basic discussion of financial markets. Bond market, stock market. As you go through your MBA, as you go through your business career, you'll study a lot more about those markets and understand what they do. There's your basic introduction into those markets. So financial markets are important, but now we're switching gears to talk about financial intermediaries. So the fact of the matter is, financial intermediation accounts for a much larger share of the overall flow of financial capital. If you go back to this initial picture that we drew, right? I mean, I kind of have it structured as if these are both on equal footing, and they're both very, very important. They're both very important in the economy. But the fact is, the amount of activity that's happening here, right? The amount of activity that's happening here is a lot more than the amount of activity happening here, okay? Financial intermediation is a much bigger part of the overall picture. So the first financial intermediary, are banks, right? I mean, that's obvious. That's your kind of your first thing that you think of when you think of, financial intermediation as part of the financial system, right? So instead of me just taking my money and loaning it to somebody directly, I take my money, I put it in the bank. That's straightforward enough. And then the bank in turn loans my money out, right? You can clearly see the bank is an intermediary there. The bank is a middleman in between the lender and the borrower. Why do financial intermediaries play such a big role, in the financial system? Why are financial intermediaries the biggest part of the overall system. The first is simply what we call transactions costs. Transactions costs. It's just easier, right? On a per transaction basis, it's easier for banks to do this than it is for individuals. If I was going to loan you money directly, I mean, I'd have to go through all the trouble of like coming up with the contracts and the legal aspect of that. But the bank has all that down, right? All these technical matters, all these technical matters that we're worried about, all the legal matters. Banks are operating thousands and thousands of these transactions constantly. So the bank can operate at a lower per unit cost than just an average Joe can, when an average Joe is just doing this periodically, or maybe only once a year or once in a lifetime or whatever. Banks can operate at lower transactions costs. The next issue of why financial intermediation is such a big deal, the next issue is risk. Hey, think about this. Suppose we're going to have half the class loan money to the other half of the class. Half the class are savers, half the class are investors. We could do that one of two ways. We could do direct finance, where one person on the lending half of the class just loans money directly to one person on the borrowing half of the class. Or I could be the bank. The lending half of the class could give me all their money, and then I could loan it out to everyone on the borrowing part of the class. Which one of those would you prefer? Which option would you prefer? Well, if we choose the first option, where we have direct finance, where each lender is paired with each borrower, if you're the borrower, you don't care, okay? Let's just be clear on that. If you're the borrower, you don't care. This is not about the borrowers. But if you're the lender, if you're paired with one borrower, and if you happen to get the borrower that defaults, then you're in trouble. You've lost all your money if you have the one guy who defaults. But on the other hand, if we all pool our money in the bank, that one person who defaults, that loss is going to be spread over everybody. And nobody's going to really come out that bad, right? The risk is pooled over a much wider array of people if we choose financial intermediation in some cases. That's a big, big reason why financial intermediaries are more important. Both those reasons, transactions costs and risk. If financial intermediaries, banks are able to operate on a lower transaction cost basis, and they're able to reduce risk. Those are two big reasons why financial intermediaries are a bigger part of the picture than direct finance. Does that make sense? Now, second piece here, mutual funds. Mutual funds are a really, really good example of another type of financial intermediary. So if you wanted to buy stocks, suppose you're just the average Joe investor. We're not talking about Warren Buffett or a rich person who has billions of dollars. We're talking about just an average investor. If you're an average investor, if you have $5,000 or $10,000 to put into retirement, you're not going to be able to buy that many individual stocks with your kind of moderate retirement portfolio. So that's a bummer. Instead, we could do this. We could get 100 people who are saving for retirement together, and we could have them each put their money into a mutual fund. They're not buying stocks directly. Each of the savers putting their money into a mutual fund. And then the mutual fund goes out, and it's the mutual fund that buys a wide array of stocks. A reason the mutual fund, that's what a mutual fund is. You're buying shares into a mutual fund, and the mutual fund itself owns a wide array of stocks. Mutual funds allow even just average Joe investors to have, a fantastically diverse portfolio. I can, even if I just have $1,000, I can go out, and it's even less than that. I mean, I'm just saying $1,000 for the heck of it, but it's even less than that. But even with $1,000, I can effectively have a portfolio of stocks. I can have a portfolio of 100 different stocks, even with $1,000. And I can do that at a very low transaction cost as well. Mutual funds allow average Joe investors to have great diversification, and it's very simply, It's very simple. The transaction cost is very low. So banks, mutual funds are both examples of financial intermediaries. They both find a role in society by lowering transactions costs and by reducing risk. They also help overcome these problems of asymmetric information. But for the sake of keeping this video short, I'm going to skip over the asymmetric information part. That's kind of a more advanced topic anyway, so we're not going to worry about that. And just a second ago in my example, I talked about mutual funds that were in stocks. The fact of the matter is you can find mutual funds that are invested all over the place. You can find mutual funds that are invested just in big company, strong, stable, blue chip stocks, blue chip companies. You can find mutual funds that are invested in small businesses, emerging small businesses. You can find mutual funds that are invested in foreign businesses. You can definitely find international oriented mutual funds. You can find mutual funds that are invested in corporate bonds. You can find mutual funds that are invested in kind of safe corporate bonds, or you can find mutual funds that are invested in kind of higher risk corporate bonds. You can find mutual funds that are invested in government bonds. The options with mutual funds are endless. I would recommend that you go to somewhere like American Funds. Just Google American Funds, and or Google T. Rowe Price, or Google Fidelity Investments, and look at the types of mutual funds that they offer. And you'll find that it's just unbelievable the wide array of mutual funds that are available out there. You can find mutual funds that avoid the stock of companies that you don't agree with. Like if you don't like cigarette smoking, or if you don't like gun manufacturers, you can find mutual funds that avoid those types of investments. Anyway, and there are two different types of mutual funds as well that I will mention. For one thing, the funds that I've been talking about are mostly managed funds. You can find funds that pay a person to pick out good investments in whatever category it is. Suppose we're talking about just big US companies. You can find mutual funds that hire a manager to pick out companies, to pick out the best stocks that are in that classification. Those are managed funds. You also can get index funds. You can get index funds that match perfectly to some index. Not perfectly, there is research on a slight disjoint, but for the sake of our class here, you can find mutual funds that match up virtually perfectly with an index fund. I personally have shares in a mutual fund that just follows along with the S&P 500. If the S&P 500 goes up 10%, that mutual fund goes up 10%. They're linked just like that. Index funds, the reason somebody would invest in those, the reason those might have an advantage is because they're cheap, right? There's no administrative cost, so there's just a minimal administrative cost associated with index mutual funds. With managed funds, you have, higher administrative costs because you're paying somebody to pick investments, to pick financial investments, let's say, to be consistent with their terminology. But index funds, there's no manager. There's just like an administrator, somebody who's actually carrying out the transactions from kind of like a secretarial role in some sense. But there's no manager who's picking out stuff. Anyway, that's the basic rundown. I'll be coming back with part 2 here soon. Part 2, I think, will probably be about the same length as this part. Again, this is a long chapter. I've skipped over a bunch of stuff. But that gives you a basic idea, though, of what the role of the financial system is, gives you a basic idea of the financial markets, the bond market and stock market, and it gives you a basic idea of financial intermediaries, what they are, and why financial intermediaries make up the bigger share. Oh, I can stop my screen share. And why financial intermediaries make up the bigger share of the overall picture. So I hope that helps, and I'll talk to y'all soon.